Hiromoto slips nearly 4% and is the top Nifty loser following weak earnings. Higher raw material costs impact operational performance. The stock down by about 4.5% now.
Pyramid Enterprises slides more than 6.5% on the back of earnings. Revenue declines 26% on a year-on-year basis. Brokerage firm CLSA downgrades the stock to underperform and cuts its target price to 860 rupees.
Max Financial too slips more than 2.5% on the back of its first quarter results. Value of new business margin declines by more than 470 basis points. The management, however, says the first quarter margin is generally subdued and will improve going forward, as a result of which the stock is off lows.
Manappuram Finance slides close to 3% despite registering a 15% growth in gold loan and a guidance of 15% loan growth going ahead. The management tells CNBC-TV18 that the heat wave conditions and general elections impacted collections. Also added that credit costs should improve going forward.
Shares of SJVN climb more than 6% after reporting good operating performance for the quarter. Revenue climbs nearly 30% year-on-year. On the other hand, HEG is under pressure on the back of weak first quarter numbers, with margins coming in at multi-quarter low. That stock too down 7%.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangala Malu. It's the final day of earnings season quarter one, so we'll be done and dusted with that. For the time being, the market's as flat as can be. The Nifty is flat. The breadth of the market is in favor of declines, but it remains to be seen whether or not there's a recovery in store. For the time being, it appears we are consolidating in the 600-point band. Hey, Mangalam.
Consolidation indeed, Nigel, and that's not bad after the rally that we've seen and the volatility that there is in the world. The only thing one will be watching out for is the market breadth. At some point in time, do we see the mid-caps go ahead and outperform or not, or undo their current underperformance as well? We have nearly 1,500 stocks declining for about 750 stocks which are in the green. Now, let's get to our first management on the show before we get you an idea for profit coming in from our colleagues at Money Control Pro. Allied Blenders and Distillers. It was a tough quarter for the liquor industry on the whole. The company's revenue was down 7%. Volumes also declined by nearly 12% on a yearly basis. We have Alok Gupta, who's the managing director of the company, joining in now to discuss the numbers in detail. Thanks a lot, Alok, for joining in. When the revenues were down about 7% with volumes declining by 11% as well, you went ahead and showed a sharp improvement in your operational performance. I just wanted to know, in the second quarter, have volumes recovered? And what's your prognosis for margins for this year?
Thank you so much. I think if you look at the Q1 performance on back of the Q4, that was the exit quarter for last financial year, actually the volumes have grown, the revenue has grown. But we compare to the quarter one of last financial year, there's a definite decline. That's largely on back of some consolidation and market prioritization that we have done. So we're quite happy with where we are. And that reflects in our operational performance. As far as Q2 is concerned, I think it's looking good. We are consolidating and we are hopeful for a much stronger quarter.
What is a much stronger quarter? What kind of volumes will you end this year with positive volumes? If yes, by how much? And is Q2 reflective of that?
Well, it's certainly in the year with a double-digit growth over the last year. And the Q2 is reflective of that.
Okay, all right. Hi, Alok. Good morning and thanks for speaking to us here on CNBC-TV18. This is Nigel on this side. Besides the operational performance, I just want to understand about the interest cost. Now, you've done the IPO, the interest cost is likely to come down dramatically. For the first quarter itself, your net profit number has come in at around 11 crores. But your interest cost is around 44 crores. Now, my guess is that if you're going to be virtually debt-free and your debt is going to come down drastically, this interest cost from around this 45 crores will come down as well. So on a quarterly run rate from quarter two onwards, what should it look like? And majority of it will flow through to the PAT, right?
Yeah, that's absolutely right. So as you recall, our IPO was dated on 2nd July. That was post quarter one. So we had the interest costs were no different than what was in the last financial year. As I stated earlier, we expect our interest cost to come down by about 50% in this financial year and only reduce from there on.
So this year, your quarterly run rate should be what, around 30 crores per quarter? 25 to 30 crores?
Maybe a little lower than that. Maybe a little lower than that.
I think half of what you're saying, so around 20 to 25 crores is what we could work with. Is that correct?
I think that will be a fair estimate. That will be a fair estimate. Somewhere a number will be in between as an exit run rate.
All right. And what happens to your margins? Because, you have two levers. One is that your premium products are increasing as a proportion of your sales. Secondly, you are increasing your own captive consumption of ENA as well. But with ENA prices remaining firm, gold or glass on the decline, what are your margins likely to be by the end of this year? Are we looking at, say, 12%, early teens?
From a gross margin point of view, we are seeing early results. We are already seeing about a 300% basis point margin expansion on our entire product portfolio, back of a greater focus on P&A, greater focus on our luxury portfolio. We are looking at our margins to be early double digit. That's really what we're working towards. But like we mentioned earlier, over the next couple of years, the idea is to get at industry parity.
So industry parity is mid-teens. That happens, say, 3 years from now. Early double digits is 11. Yes, 11-12% is this year?
Well, we are hopeful that we should be in that strike range.
So if we draw a glide path 3 years from now, you look at, say, 11-12% this year, 13-14% next year, and 15% plus coming in from FY27.
That is right. A lot of work needs to be done. I think one point that you've already covered is in terms of a consolidation, in terms of captive ENA, our continuous focus on the premium and luxury portfolio, of course, re-engineering some of our cost structure. So a lot of work to be done, but we're in the right track.
So that would mean that you'll start delivering EBITDA for the year of around 750 crores, 15% of around 5,500 crores. Is that an aspiration as of now?
Well, the aspiration is to do better, but that's direction.
That's correct. So FY27 numbers broadly should be this 5,500 crores with 15% margins?
Well, I would say yes. I mean, broadly they're in the strike range again.
All right, broadly they're in the strike range. You briefly mentioned captive ENA sourcing. So what is the proportion right now and how much will it be, say, in the next couple of years?
Well, currently about 30% of what we consume is from our own captive sources, and 70% is what we buy. And over the next couple of years, we want to get to 100% captive ENA in terms of our backward integration program.
And what's the differential between the two when it comes to costs and margin impact?
Well, I would say it should impact gross margin by roughly 250 basis points. And that will flow down straight to EBITDA.
All right. So this 15% margin that you're talking about, it factors in this 100% captive ENA, right?
Absolutely. That's a very strategic initiative for us at ABD.
Okay, all right. You're sounding pretty optimistic about business prospects, so cheers to that. But what about your market share? You know, as a percentage of the market, what were you at? What are you at? And where are you headed?
We are currently at about 7% market share. I think by end of the year, we should be looking at least 1.5% market share gain on back of the growth that we have planned through consolidation in the P&A segment, Officer's Choice, Iconic White, and Sterling B7. All three are looking good in the segments that they operate in. The portfolio rollout, the new brand rollout in the luxury segment is looking good. Zoya has started to sort of roll out nationally, and we're looking at rolling out a few more brands in this financial year in the premium and luxury segment. So I think as of now, things are good.
All right. Quickly, just before we let you go, Iconic has been launched in 3 new states, and Zoya as well as a gin that you've launched in Maharashtra. What is the proportion of your revenue that you expect to get from Iconic and Zoya in the next couple of years?
Well, Iconic, we did about 2.2 million cases last year, exiting at about 3 million. As things stand, the Q1 is indicative that we are close to about 4 million cases ARR, and we'll grow from there. So of the total sales that we are planning, I would say about 12-13% sales should come from Iconic alone. Zoya operates in a luxury segment. I think that's a new segment for us, and there it's not about volume, it's about capturing customer imagination and sort of getting a larger share of the bar, if I was to say, through the new rollouts that we have in mind.
Okay, all right, and that's visible because realization per case as well moved up by 3%. As you've been saying, you're focusing more on premiumization. So how much more upside to this number?
Well, we should be exiting the year hopefully close to about 40% gross margin, and it should only get better from there.
All right, Alok, appreciate you joining in. You're sounding confident about business. We'll track all these numbers that you have given. I'll tell you personally, I can tell you that the gin market, it's really picking up steam. Even someone like me who prefers my malt, I often on, particularly when it's a little too hot, look at the gin market as well. Thanks a lot for joining in. Wishing you all the best, and we look forward to hosting you yet again. Well, time to shift focus then and get you a few ideas for profit in our special segment, Money Control Pro. Nitin joins us to help us out with an idea that he has. Nitin?
Today's stock idea is Saregama. We recently reviewed the first quarter result, which was subdued due to the softness in the music licensing and the caravan business. Revenue grew by 26% YOY, but contracted 22% sequentially. Consequently, EBITDA margin dipped to 25%, lower both on YOY and Q-on-Q basis. Further, Saregama plans to spend around 300 crore on new content acquisition this year and a total of 1,000 crores in next 3 years. Key aim is to acquire 25 to 30% of the total content produced in India. Its carbon business is transitioning from the traditional distribution channels to e-commerce and modern retail. Hence, while the margins are expected to improve, due to this, however, volume is expected to decline as well. Company's content acquisition strategy should help it maintain a strong momentum in the licensing revenue and raise the market share in the newly produced content market. The shift to the premium subscription alone could accelerate revenue growth, given that the OTT apps are now increasingly trying to move free users behind the paywall. Saregama stock has seen a sharp correction recently in last 1 month, higher than the broader markets. The stock now trades an FY26 PE of 33 times, which is reasonable considering the medium-term earning growth potential. Investors should use the recent decline to add the stock.
All right, that's an idea for profit coming in from our colleagues at Money Control Pro. But Nigel, you spoke about being interested in the gin market.
Yeah.
You're a hardcore whiskey drinker. Increasingly, there is a fair number of people who are drinking tequila as well. A lot of people are saying tequila is the new gin. A lot of them would remember tequila as the one that is shot, but now they're sipping on tequila. So agave, mezcalita, all of these things are things that people are looking at. So maybe you want to track that as well.
You hit the nail on the head. Last Friday was tequila.
All right, last Friday was tequila. We'll watch about that later. But as of now, forget tequila. We have Texmaco Rail on the other side. We have Sudipta Mukherjee, who's the managing director, joining in to detail those numbers. Take a short break. Come back.
Welcome back. Keep an eye out on the bottom of your screen. The Supreme Court has allowed states to collect past dues in the form of royalty as well as tax all the way since 2005. This is big news that's coming in there, and they have allowed it retrospectively. The stock that you'll have to focus on is Tata Steel. And this was the big risk because as of the last quarter, they had provision close to around 17,000 crores as contingent liability if in case this taxation is applied retrospectively. They were already served various notices, and this was the important point. So among all the metal companies, Tata Steel is the one that gets hit the hardest because of this, and this has come as a negative for Tata Steel. They have pending dues. We spoke to Hindalco as well, and they said, we don't have any pending dues. There's no notice that's been given to us. But Tata Steel, for sure, we'll have to see the implications going ahead on a prospective basis from here on. And if my memory serves me correct, on a prospective basis, they'll have to pay close to around 1,500 crores. That is the back of the envelope calculation. But on a retrospective basis, potential hit could be close to around 17,000 crores, and that's what they had provided for. So this is the big breaking news that's coming in there. The stock actually has seen a correction post this question mark that was raised, whether or not it will be applied retrospectively. And now we know that the Supreme Court has ruled in that favor, Mangalam. Not good news for Tata Steel. They, as it is, have the European woes to deal with. And this has come as a bit of a negative. So we'll get further clarity in terms of that. But the big breaking news that's come in there is the most unfavorable situation has played out for a mining company, particularly Tata Steel. All
right, take that point, Nigel. The stock down 1% right now, but if you look at it, this month itself, it's down about 11%. And from its highs, it's corrected about 21% as well. So the street was worrying about the possibility of this. And remember, the results weren't bad as well. But that day, the stock was under pressure largely because of this news, this overhang coming in. And now that overhang has actually played out. So it'll be very important to see, where this goes from here on. We're dialing the lines. We're getting metal analysts, and we're trying the company as well. We'll get you more on this as we get more clarity. But as of now, 17,000 crores odd is what Nigel tells us would be the contingent liability that Tata Steel would have to pay. There is clarity. The Supreme Court has allowed states to collect this tax retrospectively as well.
Just one more factor, Mangalam, that we are getting, that the states have asked not to levy interest on the past dues. So that could be some kind of a breather space as well. But for the time being, the bigger quotient will be obviously the the initial claim. So it goes down in the negative, but once we get our reporter from Delhi, we'll try to analyze it in further detail.
Just a follow-up. I'm not sure whether you would have that number back by the back of your hand or not. This 17,000 includes the interest?
So no, we'll have to break that up. We'll have to break that up. For the time being, the contingent liability, this is the first time actually they provided for it, of around 17,000 crores on. It was around 16,000 crores as of March, which they had increased it to around 17,000 crores as of June. And when I asked the management, they said back of an envelope, it could be 1,500 crores prospectively as well. So that's pretty clear. On the retrospective basis, we'll have to see how much of it is tax, how much of it is the original penalty.
All right, so that is the breaking news. We'll keep getting you more reactions on that as well. But quickly, just before we get back to this news, we have the management of Texmaco Rail with us as well. The stock slightly under pressure, not bad performance in this quarter itself, a 35% jump in their revenue, 200% jump in their EBITDA as well. Thanks a lot for joining in, Sudipta. Just wanted your updated order book number, the execution run rate that you are targeting. What was it in the first quarter this year? And, what exactly are your bidding pipelines looking like? On these three factors, if you could quickly give us, your outlook.
Yeah, hi, good morning. So as you have mentioned, so I'm not repeating the numbers, which has been one of the highest in terms of the first quarter revenue for the company. So I can only tell that you can see in the coming quarters a significant further improvement on the performances and execution. And we can expect anything between 40 to 45% minimum over and above the consolidated basis. And order pipeline today, we have around 7,500 crore orders. And we feel that it is going to significantly improve because of the election time. So railway, the order which is due to be published, I mean, it has come up few of those in a small numbers, but we expect that the big numbers are coming up very soon within a quarter or 2 quarters.
Okay, all right. Hi, Mr. Mukherjee. Thanks a lot for joining in here on CNBC-TV18. Well, what about the execution targets? On a quarterly basis, should it be in this vicinity of around 850 to 900 crores?
So execution, as I said, that whatever you have seen in Q1, it would be a further significant improvement or jump. To quote you an absolute figure is difficult, but I can project that so far the plan of executions are concerned, you can see another, significant jump on that, which will be much higher.
Can you define significant? Your target was 850 wagons, and you also said that you are expecting a significant jump in realization. So both on execution per month and realizations, if you could give us some outlook.
So we are already into the range of 800, 850 wagons a month. So we feel that we will be able to improve upon that in the coming quarters. And if you have seen that our profitability and EBITDA has also gone up. So first of all, we want to ensure that we sustain these and of course, look forward to improve upon that.
Okay, all right. Well, what about exports as a percentage of your total mix? I think earlier you were guiding for around 500 to 600 crores. So are you on track to do that? And also Kalindi Rail, the rail EPC arm, when does it turn profitable?
So far export is concerned, we are executing export orders and we have few active inquiries also, which we feel that within this financial year, we will be able to get. So far the freight rolling stock is concerned. And as you are aware that all our divisions, if I may specifically mention the foundry, the component division, they are also executing the exports, and we have a continuous inflow, and we believe that it will grow in the coming year. In terms of Kalindi, of course, you know that we have already applied or initiated for a process of demerging, which itself is a process, and there are a lot of compliances are involved into it. And we are confident to take a concrete decision within this financial year itself, which is in the best interest of the stakeholders and the company.
No, the demerger is okay. We wanted to know when it turns operationally profitable, sir.
So operationally profitable in the sense, if you have seen, there are certain legacy contracts in the company which were on the verge of completion. That is the heartening news, and whatever today we are venturing for new orders, and I mean those you can see by the end of it's a long period contracts, and from the next financial year or within this financial year, whatever comes up, we do not want envisage a more bleeding on the new contracts, whatever we take. But as it was going on the merging procedure, so we have been restricting ourselves to be adventurous. So far, calling the order as are concerned, and we are only focusing on the niche areas, and we are participating more on a qualitative point of view rather than a quantitative point of view.
Take that point, Sudipta. Thank you so much for joining in, and apologize for keeping this short in the wake of breaking news, but we'll keep connecting to you through the course of this quarter and get an update on your execution and orders as well. Good luck for the remainder of this year. But Nigel, now looks like the street is taking note of the flash that came by Tata Steel, down about 2.5%.
Yeah, that's right, Mangalam. Just one more point. Tata Steel is the one that surely gets impacted on the retrospective basis. But for Hindalco, actually, we asked the management, they have nothing on a retrospective basis. So, we'll try to play that bite as well. We had spoken to the management. We played it out earlier on the channel as well. So, Hindalco said, they told us, Mr. Pai told us that on a retrospective basis, we haven't been served any kind of claims. So, there's nothing that can impact us. Tata Steel is the one that gets hit. But I think now, because the news flow appears negative, all the stocks are selling off. But Tata Steel is the one that gets impacted. For the others, we have to wait and watch. Some of them have not received any kind of pending claims. So some of them could recover actually from the low point of the day. On a prospective basis, we'll have to see. And a couple of points, Mangalam, here. Now, the states have been given that, that right to go ahead and levy some taxes. Many a times in the, many of the states, in the center and the state, case in point being Orissa, you have the same ruling government itself. So the battle was between whether the state can also levy besides the center. So since the ruling government in the center is BJP as well as in Orissa is also BJP, we'll have to see what exactly happens over there, or whether or not they're on the same page and there's no additional big levy that comes about. For NMDC, it'll be important because they have mines in Karnataka as well. And there's a difference in the ruling as well, ruling party in the state as well as the center. So we'll have to keep an eye out on NMDC. So it's still quite fluid. Tata Steel we know gets hit, but for the others, we'll have to wait and watch. And as I said, Hindalco, we asked them point blank. They said no impact on us because we don't have any pending liabilities that were served to us. So we'll keep an eye on that front.
We will, Nigel. On fundamental basis, Tata Steel gets impacted, but the others, sentiment rub-off taking place because of the uncertainty around the regulations that have come by. A lot of ifs and buts with regards to, state versus center, the ruling governments versus the, governments in the states, etc. as well. As of now, a big downtick, but big gash is what we're seeing on Tata Steel after a correction that we've already seen on the stock itself. With that, we'll take your leave on this edition of Chartbusters, but you stay tuned to CNBC-TV18. We will be covering this in more detail on the other shows.